Good afternoon, good evening, good morning, everyone. Welcome and thank you for joining the Integrity Council for Voluntary Carbon Markets Market Consultation Group webinar. Thanks for joining late on a Friday for many of you, I know, and where I am here on the west coast of the US, it's just getting light. So we're starting our morning off with our favorite topic, which is permanence and durability. We're excited to share today the assessment update just overall. So to provide a quick update on where the ICVCM is on its assessment process and provide some overview and discussion of the permanence final report. So as you all know, we concluded the continuous improvement work program on permanence just a couple of months ago and issued the final report and have been hard at work actually carrying forward some of those next steps and recommendations that came out in that report. But we wanted an opportunity to really dig in with you all and to have a conversation about where are we on permanence and durability as a market and how is the ICVCM thinking about these issues in light of the assessment framework and other key issues. I'm delighted to be joined here today by a really outstanding group of panelists. Lynn Riley from the American Forest Foundation, who's their lead scientist and has been leading some fascinating work on this topic that she'll share with you today. Nandini Wilkie from Carbon Pool, who's the co-founder and CEO, and Sandeep Roy Chaudhuri from VNV Advisory, who's the co-founder of VNV Advisory and was also a CIWP 5 participant. Natalia Dorfman as well from Kita, who's the co-founder and CEO and CIWP5 participant as well. And big thanks as well to Michaela, who has helped us put all of this together and bring this event to you today. So we're going to dive right into the topics that we would like to cover today. We want to talk to you, as I noted, both about the assessment decisions and have an opportunity for you to ask us some questions. So we'll be there. We'll come to that in relatively short order. Next slide, please. But before we dive in, we just wanted to get a sense of who's in the room today. It looks like quite a few folks. So we're going to pull up a quick poll, and if folks could just take a moment and answer the questions, that would be much appreciated. There it is. So we're trying to understand which best represents your role in the carbon markets. Let us know which apply, and the panelists don't need to vote. We already know where you're from, but please take a moment to just fill that information in for us so we have a sense of who's in the room. And don't forget to scroll down because there are several questions. Also wondering how you heard about the latest ICVCM assessment decision, which type of medium you're using to get your news, the key regions that you work in, and your view on what the single most important change that would improve the way permanence is addressed in the carbon markets is. And if anyone has brilliant solutions, please share them. How long do we want to give folks for the poll?
I think it'll stay open and we can move on.
Okay. Great. Okay, looks like we're ready. So I think what I'll do, we'll hand it over to Richard Diffley. Richard, how do I not know how to pronounce who is going to introduce himself and provide some information with us about the assessment update and where we are, and then I'll frame up the conversation on permanence and some of the work we've been doing there. And we'll also have our panelists introduce themselves briefly as they begin speaking. So Richard, over to you.
Thanks, Alexia. Hi, everyone. Thanks for joining. So, Richard Iliff. There we go. That's the surname. So, yeah. So, I'm just going to take this opportunity to provide a short update on ICVCM's work, and we'll just go through it pretty briefly before we get to the meat of the conversation today. So you'll be aware ICVCM does its work in two ways. We assess programs against the assessment framework, and we then assess categories or methodologies. So starting at the beginning, essentially to have any CCPs approved, you need to be an approved program. And this list here shows you a current snapshot of where we're at. I think the main updates since we last spoke, I think we've had two new approvals. So maybe I can just zoom in on those now. So ERS and isometric, they are up. If we can just go back a sec. They are our most recent approvals, which now takes our total of CCP eligible programs up to 7. This list in total is 14. So we have 7 other active applications that we're reviewing. We do hope and expect to have some more decisions before the end of the year. So that's a snapshot of the latest in CCP eligible programs. If we can move to the next slide, we can talk about methodologies. So this is the sort of most important bit in terms of operationalizing ICVCM. And so it's the CCP labels that are indicating credits of higher quality. This is a pretty busy slide. What I will say, we now have 11 categories of carbon credits approved, and that is comprising 28 different methodologies. And I think since we last spoke to you, we've had some recent decisions on cook stoves and biodigesters. So that was in February of this year. We've had afforestation, reforestation, and revegetation, biochar, and most recently IFM. So what I think this says is we're now starting to see an increasing balance of sort of community-based projects, removals, NBS, some of the more complex methodologies, lining up, balancing earlier approvals on things like industrials, which of course are the least complex methodologies, and why ICVCM managed to get through those first. So that is a brief snapshot. If I can just maybe frame where I think we are in our work. So we are keeping a track on rough volume since when we started our work. So the voluntary carbon market was around 1.7 billion. And with a quick snapshot, we've now worked our way through about 80% of that volume as of when we first started. This is historical, obviously, things are growing all the time. And what that really says is we've got about 20% of our work yet to do. And those pending decisions, the most important categories, I would say, are IFM. We still have a few other methodologies that we're assessing, and we have some outstanding methodologies on HFC, ODS, and soil organic carbon. And so a couple of other interesting methodologies, perhaps without the volume attached. We have carbon dioxide removals, of course. We have rice and enteric methane. So we do expect that we'll start seeing decisions coming out on those towards the end part of this year. So I hope that's an interesting snapshot of where ICVCM are at. I hope I've kept to time, and we can then pass back to Alexia. Thank you all.
Thank you, Mr. Iliff. I appreciate it. Thanks for the update. And I realized that I neglected to introduce myself. Sorry, guys. It's very early and I haven't had my coffee yet. I'm Alexia Kelly. I'm the Managing Director of the Carbon Policy and Markets Initiative at the High Tide Foundation. I'm also an ICVCM board member and co-chair our continuous improvement work programs. So thanks, Richard, for all of the hard work on what has been a lengthy and somewhat arduous assessment process over the course of the last couple of years. So we're really looking forward to coming to the end of that and moving on. So before we move into the meat of the topic today, and Michaela, I can't see questions. So as questions are coming in, can you flag for me where they might be? It doesn't look like we have any, so we'll just keep rolling. Before we begin our discussion today, though, I'd like to remind everyone just what the ICVCM Continuous Improvement Work Programs, or as we affectionately call them, CIWPs or SWIPs, are to help provide some clarity about the scope and the process. The CIWPs are focused time-bound inquiries that bring experts and diverse stakeholders together to answer specific questions and address challenges that are core to building integrity in carbon markets. Their purpose is to surface evidence, test options, explore best practices, and clarify roles so that, where appropriate, the ICVCM can refine guidance through the assessment framework, which of course is our rule book that you're all very familiar with. And where better placed, other market actors can carry solutions forward. So not every recommendation that comes out of a CIWP will necessarily be implemented by the ICVCM itself, as you'll see today as we are looking at ways that we're moving our work forward on the important, meaty, and thorny topic of permanence. So on permanence and durability, our CIWP convened a broad group to assess durability risks and management tools across project types and geographies. It was really the first time that we had had the opportunity, I think, as a market to kind of take two steps back and look across the full set of approaches that have been developed by the various standards bodies over the last, 20 years or so to address the issue of risk and figure out how do we balance what the atmosphere needs, what the market can bear, what's legally doable and implementable, and what's scientifically defensible. And so solving for those different metrics was really a core objective of the conversation. So the Permanence Final Report, which has now been available on the website for some time, distilled a number of core conclusions. The need for a clear shared risk taxonomy. So that was a really interesting finding, was that actually every standard group shares or defines risk and assesses risk in slightly different ways. And as we're thinking about mobilization of institutional capital, that can be a real barrier to actually mobilizing in a consistent way investment dollars that are trying to understand, if I invest here versus here, what are the risks that a reversal will happen or that will have a liability down the road for a replacement obligation. We also talked about transparency on liability allocation. So there's additional work I think that's required in the area of transparency for the market, and really wanted to look at a diversified toolbox to address the issue of permanence. So things like pooled funds, insurance products, and we have a couple of super experts on the panel today to talk to you about the evolving role of insurance. It's really exciting to see more traditional kind of financial insurance market approaches come into this space, and I think we're learning a lot. And there's a lot of opportunity and potential for thinking about how insurance can help us really move this set of issues forward. We also looked at pooled buffer reserve options and risk sharing arrangements. So those and a number of other recommendations like buffer pool stress testing pilot for the programs is an example of the recommendations that came out. So since publishing, we've really moved from findings to targeted follow through. Some of this work has naturally continued outside of the ICVCM, and you'll hear more about that today. For example, one recommendation that was made by the CIWP coming out of that conversation was actually to explore system-level approaches to permanence. So could we design a market-wide approach so that each of the individual standards doesn't necessarily have to carry all of that risk and weight? That work has advanced through a feasibility assessment that we've been funding from the High Tide with the American Forest Foundation on a permanence fund and trust model. We really look forward to learning from that study when we continue the work in ICVCM's next planned CIWP on permanence, which will move forward both in these more targeted focus areas as well as a convening next year. In parallel, we're also getting more surgical, so looking at working with standards and infrastructure providers to determine what can inform future assessment framework updates and what guidance really belongs with market bodies and where the ICVCM should partner alongside others to progress that work. The CIWPs are intentionally iterative and research and engagement cycles. So they really ask and answer defined questions, clarify who does what next, and keep the market moving overall. So with that frame, today's panel will look at how funds, policy, insurance, and risk sharing in the market broadly are evolving, and what the next 12 months should prioritize to make carbon credits robust and investable. So we've come a long ways, but we also have a lot of work to do. So I'm very excited to introduce our panel today. And I'm going to ask our panelists to both give a brief introduction of themselves. And Lynn, I'm going to come to you first and ask you, this work around the Permanence Trust that came out of the Cambridge workshop that we had now a year and a half ago in Cambridge, really walked away with this notion that like, geez, maybe there is a more global approach to this issue. And so can you tell us a little bit about how AFF has taken forward the permanence fund idea, the problem you're trying to solve that buffers alone didn't, and how triggers, payouts, and governance will work in practice as we start to work through the feasibility of this initial concept?
Yeah, thanks, Lexia. So yeah, like Lexia said, I'm Lynn Riley from American Forest Foundation, or AFF. I'm the lead scientist there. Before I dive in, I think most folks on this call probably know, but I did just want to give a sentence or two on how buffers work, because this is really the primary mechanism in the market today that's being used to address permanence and durability. So typically, a project will use a risk rating tool that's provided by the standard to do an ex-ante estimation of their reversal risk over a set time period, usually about 100 years. So these tools will look at things like financial risk, future climate change risk, political risk, and they'll kind of calculate together how many credits for the project to set aside into the standard's pooled buffer. So these credits are pooled with other projects. And then the buffer is there to essentially help compensate for if there are reversals based on those estimated risks up front. So I think buffers are really a great tool, and they've really helped the market scale to where it is today. And I think they do have a role going forward. But AFF is a project developer. And so really early on, just on the project scale, we did notice a few ways where buffers weren't a perfect solution for what we were trying to do. So AFF designs projects for improved forest management and reforestation for small landowners. And we realized really early on that for these small landowners, at least in our context in the US, they can't really accept very long-term contracts in most cases. So these reversal risk tools that standards use tend to place a really high value on contracts, so like 100 years in length. And the landowners that we were talking to felt like that placed an undue inflexibility on their future heirs that really limited their willingness to participate. So we had to think through, how can we really achieve these 100 years of durability with meaningfully long landowner contracts, but shorter than 100 years. So we came up with this idea for what we called, just at the project scale, a permanence fund, where we use 20 to 30-year landowner contracts. And as we sell the credits, we place revenue from those credit sales, a portion of the revenue, into a fund that grows over that 20 to 30 years of the landowner contract. And we use that for continued technical assistance for our landowners, for monitoring, and then ultimately for compensating for reversals that we identify after those landowner contracts are done. So that was at the project scale. Then we look out to the wider market scale and talk to a lot of other project developers engaged in the CIWP. And there was a couple other problems that buffers alone don't seem to fully solve for. So first is these buffer tools are really designed, like I said, for roughly 100 years in length typically, but they don't necessarily internalize the full cost of durability that addresses the full climate impact of an emission when carbon credits are used to address emissions. So those emissions can last for centuries to millennia. And so if the buffer pool is really only designed to cover around 100 years or so, that could mean that we're leaving those very long-term reversals to be shouldered by future generations. So that's kind of one area. And then the second I wanted to mention is the current buffer tools are very highly relying on these ex-ante estimations of reversal risk. And there's really not any sort of ex-post monitoring so that you know if your prediction of how many reversals were going to happen actually came true. And so if the buffer is actually sufficient or if it may have been undersupplied. And if we do find that it was undersupplied, you've already placed your credits in the buffer, so you're kind of left with this inflexibility to have any sort of recourse if we learn later that we got it wrong. So that led us in this CIWP to think about, okay, maybe we have this project level permanence fund. What could that actually look like for a market-wide mechanism? So in the permanence trust model that we're thinking about now, instead of predicting how many buffer credits to set aside today to address reversals centuries into the future, the permanence trust will use a reversal risk estimation to say how much would it actually cost to manage, mitigate, and ultimately fully retire that permanence liability through things like investing in more durable forms of CDR. So we think this could really help clarify the liability of permanence and price it into the credit and not have that be shouldered by small landowners or future generations. It also creates this pot of money that we can use for that long-term monitoring and also that dynamic remediation. So we're not necessarily quite so reliant on those upfront estimations of reversal risk, which we know that humans are not really great at predicting things that are centuries into the future. So it kind of frees us up from that and lets us dynamically address this reversal risk when it actually happens. And then if you all could go to the next slide, I did want to just show a quick illustration of how we think this could work, but also name that a lot of our questions about the actual rule book of how this would work are live. And like Alexia said, we're doing a feasibility study with some really incredible partners right now. So a lot of these are live, and I'm grateful for the group on this call because we'd love to invite engagement from the stakeholders here as well on this. But first, just an illustrative look of how something like this could work. So this is an example of, let's say, improved forest management, although I should say that we envision the permanence trust to be technology agnostic, so not just for nature-based, but could be for any project that has a reversal risk. So we have on the left side there our crediting period where the black line is maybe a project and then the white line is a baseline. So we're comparing a project to a baseline, we're issuing credits. And during that time, a buffer might make a lot of sense. So we might still use that buffer mechanism to just cover the risk for maybe the first few decades. And meanwhile, while a project is issuing credits, they would also be placing a fee into the trust based on that project's estimated reversal risk of the credits that it's issuing and the cost to ultimately fully retire that liability of permanence after the buffer pool period is over. So then after that sort of credit liability period where the buffer is covering the liability for those reversals, the liability for reversals would fully transfer to the trust, and the trust is able to take that on because it's had that upfront fee being paid into it and growing over time. So at that point, the liability for reversals is not on the landowner, it's not on the project or the standard or the buyer, it's just held by the trust, and the trust's responsibility is then to manage, mitigate, and ultimately retire that liability. It could use things like insurance, it could invest in more durable forms of CDR to use for horizontal stacking, all sorts of things like that. We've got definitely some open questions and challenges to address in actually making this operational. So things like, how are we defining a reversal? How do we know a reversal has happened? What is that credit liability period that we're going to use? Should we include things like predicted regrowth of especially like forest-based projects where we know they might have a reversal, but they could regrow later on? Also, who's going to own and manage such a trust, or maybe there's going to be multiple trusts. Those are things that we don't know right now, but this feasibility study we hope will help us figure that out. This should be, we're thinking at the market scale, so maybe a public entity or nonprofit or multiple, like I said. We're looking for it to be really transparent. And then one thing that I've been thinking about in terms of keeping it highly credible is we just want to make sure that the system we set up doesn't incentivize underreporting or under-identifying reversals. And I think if we can do that, this could be a really credible mechanism.
Great. Thank you, Lynn. I'm going to move us along, but reminder to folks that we do have a Q&A button, so feel free to submit questions as we go along. There's a lot to this concept, but really appreciate the work and the update on that set of conversations. And just to be clear, this is one of those things that we hope the market will kind of take forward and evolve itself. It's unlikely that the ICVCM would have a direct role in managing such a facility. And how that then ties back to the assessment framework is very much an open question. And so as the market rules and regulations continue to evolve broadly, these are places where we are actively looking to feed these back into our consultation and update processes, and will be, provided to the board of the ICVCM for consideration as we think about updates to the assessment framework. But this is a long-term project and inquiry, and we don't anticipate will change anything in the near term in terms of the way that permanence is addressed in the market broadly. One of the exciting new developments, though, that we've been seeing is really the emergence of insurance products, and really thinking about more traditional financial market insurance product approaches to addressing risk across a wide range of issues, not just liability, but other types of risks in the market as well. So very excited to have Nandini here today to share some updates with her on how they're thinking about underwriting permanence risk today, looking at data, scenarios, capital requirements, and then also how regulated insurance sit alongside buffers. So how is the insurance market interacting with kind of the current market structure, and what types of pilots are you participating in to test this approach?
Sure, I'm happy to comment. Thank you very much to Alexia and Michaela and the ICVCM for inviting me to be a part of this discussion. I see lots of familiar faces on the panel, and it's good to see all of you. Good to see all of you here. My name is Nandini Wilkie. I'm one of the co-founders and the chief operating officer of Carbon Pool. I've spent the last 15 years of my career really deeply immersed in insurance. So I'm happy to be here to speak a little bit about it. So I think going to the first question, what Carbon Pool does in particular, but what insurance companies do, is they are very good at assessing risk and pricing risk. That is the sort of one of the key functions of insurance in many mature industries, and also in sort of creating a centralized risk-bearing capacity, right? So buffers right now are maintained across different registries. Insurance companies do have a sort of centralized risk-bearing capacity, and that's one of the things that makes them very efficient at being able to offer risk mitigation tools. So what we've been doing at Carbon Pool over the last couple of years is thinking about how insurance can help to mitigate for reversal risk. And I will make the point, Alexia used the word emergence a couple of times. Insurance has been absent in the carbon markets, and shame on us, frankly, right? So I'm glad that we're finally getting here. Buffers were evolved at a time when insurance wasn't available, and buffers are a form of self-insurance, right? They're pooling credits across a bunch of different projects to cope with permanence risk, which is a perfectly sensible idea. And I think now insurance has finally caught up and seen, okay, well, I mean, we've been doing this for a very long time. How can we take that concept and improve on it? So at Carbon Pool, how do we assess for reversal and permanence risk? So what we've done is we've got a team of climate scientists. We have built our own in-house carbon risk model, drawing upon data sets that have been developed over many decades, that look at weather risk in particular jurisdictions. And we are also looking at forward-looking climate assessments, understanding, of course, that those are full of assumptions, and how that actually ends up bearing out will depend a lot on human behavior and policy choices and so on. But nevertheless, we take climate risk assessments and we look at, let's say, the next 5 to 10 years when we are underwriting for reversal risk. So what we do when we get a project, we will look at the shapefile. We will put it through our carbon risk model to identify, okay, what are the chances that there is going to be a wildfire or a drought or an excess precipitation event? And then we figure out how much damage is that likely to cause. And we put that all through a probabilistic risk analysis. So basically we run it through a simulation 100,000 times. So that is a sort of very typical, that's what insurance companies do. That's how you come up with a sense of what is the probability that this risk is going to occur. And then we put a price to that. And that price is a function of a couple of things. It is the pure cost of sort of if that thing materializes and we have to pay a claim. And at Carbon Pool, we pay in kind, like a buffer pool. We don't pay in cash. We think it's really important that what we're trying to replace here is a climate a reversal. So there was a removal or an avoidance, and that has been reversed. So now that CO2 is back in the atmosphere. And so we think, our unique proposition, let's say, is that is done in kind, and it is consistent. Our payment is in kind. We think that's consistent with how buffer pools have operated up until this time. That's not to say that there aren't other approaches that work. That just happens to be our particular one that we think is quite suited for this purpose. So we run this thing through our model, and it comes up with a price. What is the price? The price is a function of how much the risk is, how much it will cost us to replace that lost carbon credit, and that's how we come up with a price. The price is useful also if you are a buyer of carbon credits, because you can use the price of buying reversal insurance for project A versus project B. It will tell you something about how risky that project is or isn't. So that's the basic premise of how it works. And I think there are a couple of sort of key differentiators between how buffers work and how insurance works. I mean, at the moment, the risk assessment that's done by buffer pool by the registries is not the same type of probabilistic risk assessment as is done by insurance companies. So I think there is certainly that is a certainly an improvement and a step, I think, towards professionalizing the market, which I think is quite helpful. The other thing is it's a regulated solution, right? So you do have a regulator looking over your shoulder. I mean, we need to be able to pay our claims in even the worst case scenarios. I mean, literally, we're regulated by law. We need to cover events that have a chance of occurring once in 200 years. So that's a pretty significant buffer that we need to maintain in order to be able to pay our claims. And the other thing is it's transparent. This is you will know what kind of credits you're getting from us. And we, as the insurance company, because we have skin in the game, our capital is at risk, we have a really strong incentive to get the pricing of the risk right. And because we have a contract with the insured party, that could be the developer, it could be the Permanence Trust, for example, it could be anybody, right? Whoever is the person who is sort of liable for the permanence of those credits could be the insured party, and we have a contract with you. So when there's a claim, we know you know what you're getting from us. So I think so much for insurance and buffers. How does insurance sit alongside of buffers? I think the market is still working this out, right? That's what we're all here to talk about. There are lots of different solutions and lots of different ways to think about this. I think that right now, buffers are covering risks that insurance companies typically don't cover, right? They will cover some avoidable reversals. And sometimes that's challenging for insurance companies to cover, especially if there's sort of a moral hazard that is created where you're insuring something that is within somebody's control. Insurance is at its best when it's covering big events that are outside of somebody's control. So natural catastrophe. And if you consider that fire is one of the greatest risks to standing forests, insurance is particularly well suited to cover for those kinds of random catastrophes that are not within anybody else's control. So I think that is definitely something where somebody's still got to figure out who takes on those avoidable reversals. I mean, now I would argue that's not the developer's job in a way, right? It's not the developer's job to cover reversals forever and ever. I mean, right now, the way the market is looking at it, it's either the developer or the registry who's sort of covering that in perpetuity. I do think there's an important question to be answered as to who takes on those avoidable reversals. Ultimately, if you ask me as an insurance person, I think the liability really needs to sit with the end user of the credit. The end user of the credit is the person who is reversing, let's say, the pollution by using the credit as an offset. Now, I understand that the market is not there. I also, however, just want to make the point that we want to incentivize developers to bring really good quality projects to the market. And if you make the cost of that so high by making them cover permanence for a really, really long duration, that can really make it hard for developers to bring projects to the market. The other thing is, if you just think of a simple analogy. When you buy a car, the manufacturer will guarantee that it works for a couple of years. But like if you crash it, they're not going to pay for that. That's your liability. And if it stops working in 20 years, they're also not going to replace it, right? So I think there are parallels to be drawn from other industries. And finally, with respect to pilots, at the moment, I mean, we were really excited to read the SWIP. I'm glad you told me how to pronounce that, Alexia, the SWIP. The SWIP's guidance, and in particular, this notion of an innovation sandbox to where people are being encouraged to try out new approaches, which is super exciting. So Vera, as I think a lot of people will know, in its most recent consultation, asked for inputs about a pilot to use reversal insurance in place of a buffer pool contribution. So that is something we are very actively involved in. We have a long line of developers who've sort of signed a letter of support saying, look, we're really interested in this because the insurance cost to us is much more manageable than these large contributions of credits into the buffer pool. So that's a super exciting development. The Climate Action Reserve has just announced yesterday, I think, on LinkedIn, I saw that they are convening a working group also to talk about different approaches to permanence. I think the responses to the Article 6.4 consultation, over 50% of them, we learned that thanks to our AI tools, do endorse insurance as a means of managing the permanence problem. So I think it's an exciting time. It's an exciting time to consider how insurance can be used to mitigate reversal risk.
Great, thank you so much. And you actually answered a couple of the questions, some fantastic questions in the chat here. So I would encourage panelists to take a look at those and answer them. And I wish we had 3 days and not another 20 minutes to talk about this stuff, because there's so many things I want to dig into and what you both just presented. But I also want to make sure we hear from our other panelists. So thank you so much for those insights, Nandini, and please feel free to respond to some of the questions that were specific, because I think we'd all love to see the answers in the chat. Sandeep, I'm going to turn to you now because you participated in CIWP 5, and one of the things that I really appreciated about what you brought to that process was really sharing the on-the-ground implementation perspective for folks who are really actually building projects with frontline communities and thinking about the impact there. And so as we were considering whether or not to make a recommendation to extend, beyond the existing 40-year requirement in the ICVCM and what that looks like, I think you had some important input to that I want to make sure we touch on. So from your perspective, like, what types of risk sharing models really keep projects investable without shifting undue liability to communities? So somebody in the chat mentioned, the sell side is carrying most of the risk right now associated with reversals and liabilities. How well is that working from your perspective? And are there other approaches that we really should be thinking about?
Yeah, thank you, Alexia. And finally the report is out. It was a lot of hard work by a lot of people. So yeah, I mean, please feel free to give us some advice as well. This is a very complex problem. I don't think there is one answer to this. So I think and the problem gets more complex in our world. So I represent VNV, it's a project developer. And as Lynn mentioned, if American landholders are having a problem signing off on a document for 40 years or 50 years or more, you can imagine what might happen in Asia and Africa, where our landholding is less than 1 hectare per smallholder. So that is the basis of where shifting liabilities come in. And I think that's where this problem gets very complex, but there are solutions, and the complexity is as one, and I want to just take a step back here. One is that this is just as a disclaimer right up front for anybody who's on this webinar. Permanence does not equal quality. It is one parameter of quality. Let me just be very clear about that, because I think permanence sometimes is conflated with just that one parameter that makes it a quality credit. There are lots of other issues that would make a quality credit, or lots of other parameters. And one of them is a permanent solution, which is the social function. In the world that we work in, our risk management is basis the social sciences of a project. At the end of the day, the risk of reversal, when you talk about avoidable reversals, a lot of it depends on what the social structures and the social designs that you've created around projects. And that includes, ARR, IFM, Red Plus, call it what you may. But all of these different areas, there is a huge risk management that has to be done from the social side of things, because you're talking about livelihoods, you're talking about leakages, you're talking about a lot of other reversal events that might happen. I am a fan of this report from the perspective of at least there are some solutions that we can look forward to. And I'm quite a big advocate, or I would like to promote the idea of the trust and the insurance working together, because I think there is something to work towards. And I think that shifting liability, because right now, all of the liability is on the developer side, who then actually puts all the liability on the landholder. And I'm just talking about nature-based projects here. And that is not fair, because I don't think one player within the entire landscape of carbon markets should take all of the liability. And I think what we are trying to do is the shared liability thing, where the buy side also shows up, starts paying for that same permanence that you keep asking developers for, because I think that's a very, very important concept. And I think we will need to go through a whole education process with buyers as well, saying, guys, if you need permanence beyond a certain amount of time, because financially speaking, by the time you've raised capital, done a project, had carbon issuances, your commercial horizon is just that much. It's 20 years, 30 years, tops 40 years. But if you're looking at permanence beyond it, you will have to have mechanisms which go beyond the carbon credit revenue, and because then you're funding another 60 years. Where is that money going to come from? So it's very easy to say, yeah, we need 100%, 100-year durability. I am actually very confused where that will be financed from. And, and the current discourse that we're seeing across different permanence debates, including the Article 6, is going to be extremely prohibitive for nature-based carbon credits. It's not going to work. It's as simple as that. So I think we need to have a pragmatic solution, which this group is trying to work on. And it has to be something that works for everybody, and not just for one segment of the market, because as we know, we need everything to work together. And and for me, climate change has always been a social problem as well. It's a problem of adaptation, it's a problem of biodiversity, and it's a problem of CO2. So let's not conflate durability of CO2 as just the only silver bullet that's going to solve the problem that we have at hand. So we need something that works for everything, and that's where I think pragmatism of this particular CIWP SWIP, let me just call it SWIP, came in handy, was to actually get some of these realistic solutions on the table. And yeah. Thank you, Alexia. Thank you.
Yeah, thank you so much, Sandeep. And I mean, that really is the challenge before us, right? Is how do we solve for this sort of many-headed hydra of a challenge, where we're thinking about what the atmosphere really needs, what people on the ground really need, what the intermediaries need, what the developers need, and how we connect all of these dots so that at the end of the day, we really do build a system that's delivering what we need from a climate change mitigation perspective, while also actually working in the real world. And I think that's just the constant tension that the carbon market deals with. And thank you all for being such important parts of puzzling through all of that. So last but most assuredly not least, I'm very pleased to invite Natalia Dorfman, the CEO of Kita, to offer some remarks as well. And then we're gonna, just given time, jump right into answering a couple of the questions before we wrap. We've received some outstanding questions. Thank you guys for all the really thoughtful engagement on this. And I wanted to double click on Thomas's remark in the chat too, which was just a lot of focus on nature-based project reversals. Please be clear that all of this is intended to cover all types of credits, and that all types of projects, have some form of liability, reversal liability risk that needs to be assessed for sure, and then also thoughtfully managed over the life cycle of the crediting period and the implementation of the actual project. So I think there's going to be some exciting new work happening on really thinking about what a reversal risk taxonomy that is more standardized and more detailed is going to be happening over the next couple of years or so. But we definitely have more work to do, I think, in coming up with that standardized definition and set of taxonomies related to understanding that risk particularly as we look to more traditional insurance markets and financial institutional investors to come into that market. So, Natalia, from your perspective, what's actually working for making buyers whole and preserving trust in the market with respect to permanence? And there's been a lot of talk right now around Article 6 and the emerging rules under 6.4 and PACM. So, how should insurance and guarantee instruments be recognized under those types of standards? And what types of policy clarifications would really let insurers underwrite permanence risk at scale? What's holding the market back from getting to that next level of scale and formalization?
Yeah, of course. Hi, everyone. I'm Natalia Dorfman. I'm the CEO and co-founder of Kita, a specialist insurance company for the carbon markets. Alexia, there's big questions in a short period of time, so I'll try and answer them.
We're just going to give you the easy ones.
Because I know we want to go through some of the Q&A. I mean, to be fair, in terms of what has worked to date, I think the only thing that has really been there to date is the buffers. So if we are going to be fair, particularly, I know there are people on the carbon standards here who work on the buffers, like they have performed a role, and they have not been at a macro level wholly wiped out, right? So I think they certainly have performed a useful role. I would echo what Nandini said. I obviously also think that insurance can play a very strong role here. Also echo what Lynn said. I think the Permanence Fund is an excellent idea, and that echoes that sort of systems-wide approach where things can interact with each other. But when the buffer started, they didn't have those options available, and they have performed a strong role. I actually think one of the biggest challenges within the buffers is the lack of understanding across the widespread market participants as to how they work. And that lack of understanding, which actually within the working program where we spent hours like literally going through how does this standard consider, how does this standard, and one of the actions that we came out with was we should have consistent definitions at the very least for avoidable and unavoidable reversals. But if we don't understand it as experts within a working group, how can you expect anyone else within the market to understand it? And if you don't understand it, then you're not going to trust it. And so I think that has been one of the key challenges with the buffers. It's just that lack of trust that it actually is dealing with permanence is almost a concern, irrespective as to how well it actually is doing so. I would echo Nandini, therefore, that I think insurance can certainly play a role in part because of that regulated function and that transparency and knowing whether or not you've had an insurance claim. You know whether or not you've had an insurance claim and whether or not that insurance claim has been paid, and insurance companies are able to provide that ongoing monitoring and trust in that way. But I won't go into it in too much depth because Nandini has already covered it so effectively. I think in terms of just on this same question in terms of what has worked, but how can we make it work better? I think some of the outcomes of the report are worth emphasizing. I do think a shared risk taxonomy and shared language is huge. I think we all know as humans, if we don't have a shared language, we quite literally can't communicate. And so that as a core thing to work towards seems not too difficult. Like we could have the same definition of avoidable and unavoidable reversal. I think one challenge that comes down to the second question of how do you enable the scaling of insurance policies in this market, almost irrespective of whether it's the voluntary market or CORSIA or Article 6 or what have you, is the agreement on where the liability sits. And again, we reference this in the report, but this is specific, like who owns the liability for this? I agree with Nandini and Sandeep in saying that it's very challenging to put all of the liability on the project developer. I think that is unfair in today's market. But I also agree with one of the comments in the chat that I think it's unrealistic to pin that liability and that cost, or maybe not the cost, but the request for them to take an additional action to manage the liability themselves on the buyer in a market where we are constrained by buyer demand. That feels unrealistic that they'd be willing to take that step. But I think the market defining where the liability sits is a core determinant of, well, then who takes out the insurance? Because at the end of the day, who is holding the liability is the entity that normally would take out the insurance policy. And it's quite hard for people like Nandini and me when we're speaking with companies and working with transactions, and it's slightly unclear who's holding the liability. It makes it much harder for us to determine who takes on the insurance, to structure the insurance and thus have an insurance policy that scales. So I think that's something that certainly across the market, but certainly for people who are working on incorporating insurance into specific subcategories such as Corsia or Packham is first as the sort of starting point, first principles, determining where do we want the liability to sit, which market participant or participants should take the liability, and what liability does that look like. Once we've determined that, then the core role of insurance is what we would call risk transfer, right? There is a risk, it is sitting on somebody, and you transfer that risk to the insurance company. And that clarity of definition, I think sometimes is lacking, and that creates challenges. And I suppose I probably forgot the other aspect of your question, Alexia, but I did see in the chat there was a comment on unit droit and the lack of clarity on the legal nature of carbon credits, and also the sort of scalability, I think, of insurance in terms of regulatory frameworks around the world. I think just for that question, there's two sub-answers to that. So one is around the regulatory frameworks. Nandini, I would expect this is the same, you and us, but please jump in, of course, if it's not. We have two things. One is the location of our client, where any insurance company will either be regulated in that jurisdiction or not. And then there is the location of the underlying carbon project, where we don't tend to have regulatory restrictions on where the underlying project can be. So we, for example, have insured projects all around the world, but where the entity buying our insurance is in one of the countries where we have insurance regulatory licenses. I do see, however, that is a potential challenge for the scaling of insurance to replace buffer contributions, in that it might be challenging for developers who are located in countries where insurance penetration is less to access the insurance at scale that they need. So I think that is something that when we're determining pilots, like with Vera, that should be taken into account. And then on the legal nature of carbon credits, our general counsel is actually attending the meeting next week in Rome in discussion on this. I think it's a fascinating conversation. I think right now the way we have dealt with that is quite effectively via the contracts that we insure, where in essence we are sitting behind a legally binding contract, and we are following the contractual commitments within that. And so to some extent, the legal nature of carbon credits is slightly outside of the pure contract, but we do consider it within the claims process. And so, for example, with buffers, one thing that we think will be quite challenging is if there was an insolvency of a carbon standard, what impact might that have, for example, on the ownership of resulting credits? And might that, I think there are some legal challenges that can still be worked out, but in a day-to-day sort of insurance policy, we tend to follow the contractual frameworks.
Great.
I tried to do that quickly, so
that was amazing. Thank you so much. You guys are such great panelists. You just answered the questions on your own, so thank you. I did one question I wanted to come back to, and I know we're running short on time, but somebody actually asked about the basis of the insurance and whether it's based on your investment or on the credits generated by the project. So maybe if you could clarify there. And then a question around, can project proponents, shoot, Michaela, when you answered that, it disappeared. There it is. The project proponents are a government. Can governments also access insurance products? And is there any kind of different considerations that would need to be taken into consideration if a government is a sponsor of a project?
Nandini, do you want to take one of those and I take one of those? I can do the government one quickly.
Yeah, why don't you start?
We've gotten this recently about the government acting as a proponent. I mean, technically there's no reason why the government couldn't. It's just that the size of the insurance and the interest of the government. But if the government is sitting with a liability that it seeks to transfer, I would say that's probably much less likely. Insured for us, we'd be expecting to have private companies be our clients.
Mm-hmm.
And as to the first question, which is, if I understood correctly, what's the basis for the insurance? Is it your investment in the project, or what's the basis? When we insure against reversal, we're insuring against credits that are already issued, right? So the sum insured is not a cash number. It's you come to us and you say, look, there have been 100,000 credits that are issued. I would like to insure these for reversal. And that's the sum insured. It doesn't matter to us how much those credits cost to produce or how much you sold them for. The only thing that matters to us in terms of cost is how much is it going to cost us to replace them, because we have to put those credits on our balance sheet as soon as we sell you a policy. I mean, we have an ongoing buffer, of course, but we have to put those credits on our balance sheet in order to be able to have them in case we need to pay a claim.
Great, super interesting. And Leslie had a good question in the chat too, which was, have you made progress in getting banks to issue letters of credit to developers or projects which are backed by insurance? Have we seen a shift in kind of traditional financial markets being willing to come in on the back of insurance products?
To be honest, I think we've seen a huge shift in this, and really probably over the last 6 months has been a huge shift. I think the majority of our deals now are coming in as project finance type deals, where there's some kind of pay on delivery offtake, some kind of financing. And I will say, actually, again, coming back to the liability transfer point, that developers are increasingly being asked to take on a sizable amount of liability. And so where we are seeing is that the insurance can ideally come in to really take away some of that liability that's currently sitting on the developer and sitting on their balance sheet, transfer that to the insurance company. Ideally, it should still make the bank or the off-taker feel comfortable that a creditworthy counterparty is now providing the compensation in lieu of the developer, and it should make it more cost effective for the developer. But there's been a huge influx in that type of inquiry over the last 6 months.
Yeah, great. And I did want to come back. Thank you for that. I did want to come back to one of the questions that we saw, which was just on this idea of buyer liability and how that shows up in the market, and wanted to draw folks' attention to the report that we issued in advance of the Cambridge, or I guess it was actually after the Cambridge workshop, but that just was sort of our summary of both how things are working in the market today and also a review of the different approaches to permanence that the market has taken and how well those have worked. And so I think, to Max's point in the chat, we did, buyer liability has been really difficult to operationalize in the market despite numerous attempts, through the Kyoto Protocol and the CDM with the temporary certified emission reduction credits, and then in California with the buyer liabilities. And so I think as we're looking at long-term solutions and really thinking, towards looking at a more systemic approach to addressing permanence, we're really going to need to balance those considerations carefully. Hopefully the link in there worked. I just dropped, it just went to the hosts and panelists. Sorry, I'll send it to everybody. Or maybe somebody who has more technical skills than me can do that. Because I'm not seeing an option there. But thank you. That report is a good background, because I think one of the things for those of us who are a little long in the tooth in this market find is that we tend to sort of have the same conversation about the same set of issues every 5 years, and then everybody comes in and wants to reinvent the wheel. So hopefully the ICVCM and this type of conversation can help avoid that a little bit, so that we can learn from the incredible amount of work that's gone into trying out different things and figuring out that some of it doesn't work. But I think things will. Oh my gosh, it's 7:57. So we have 3 minutes and a million questions that I wish we could talk about all day. We can't though. So what we will do is we will capture all of the questions that you guys are asking and seek to answer some of those. Maybe we'll do a lightning round of folks before we wrap. So 30 seconds each on what you're most excited about coming next. Pop quiz.
I would say I'll go first. I'm actually quite excited about the Permanence Fund. I think it's great, and you guys have been so focused on pushing it forward. And I think going back to that systems-wide approach, it has the potential to interact in a beneficial way with many other initiatives that are driving forward this conversation.
Awesome.
Yeah, I totally agree. And maybe just to add on to that, I think what excites me most about the Permanence Trust is just that in addition to all these different mechanisms working together, it also helps all these different project types really work together, and things that are scalable today, we can do today, and then also put funds into things that we hope will scale in the future. So yeah, really exciting. And again, would just want to encourage folks on this call to engage with us, because we'd love more market engagement on that.
I'm super excited that we're all here talking about this really important issue, given what else is going on in the world, and just knowing that there is a huge community of people in this world who actually really care about what is happening to the climate, notwithstanding the political climate. So I think that's important to acknowledge as an American. I feel like that's very close to it's very, very top of mind for me these days. But indeed, I mean, I think I'm excited also to see that insurance is now a part of the conversation, just because I'm an insurance nerd, and so that makes me happy. And I think that it can benefit. But I really appreciate the work and the thinking that goes into the permanence trust, because the truth of the matter is, yes, Max, I saw your comment. I agree. Like, in this market, buyers have all the power, and so buyers are not going to be the ones who want to have the liability. And I also understand from their point of view that they don't want to sit on a liability for 100 years, right? I mean, that's why the Pension Benefit Guaranty Corporation of the United States was invented, in a way, right, to backstop these very critical liabilities after the actors who gave rise to them and who were looking after them for some time were no longer around. So I do think that this is a unique thing, and it calls for unique solutions. And I think insurance can be supportive both of the permanence trust and of other issues. What I do want to make a plea for is to treat developers fairly. And it's not only because I think Sandeep is great and BNB is great. What I see, though, is from the big buyers in the market, I see the market's ours, we have all the power, we can ask for whatever we want, and saying to a developer, hey, go get me, in addition to finding investors to fund your projects, hey, go get me a letter of credit to take care of any liability I could ever possibly fathom. I mean, that just doesn't happen in other contexts, and it's not fair, and it's not going to move the ball forward. So I plead, it's my plea for sort of a more rational, balanced approach, because I think we're all rowing in the same direction. Ultimately, but things like unreasonableness in that way, it doesn't help.
Great. Well, we are at time. Sandeep, final word.
Yeah, no, look, listen, I don't think developers, from a developer perspective, and this is just my perspective, I don't think we want liability on the buyer. We want the buyer to pay for that liability. That's about it. I think there's a big difference in understanding where the liability lies. I don't think any developer will want to, put the avoidable liabilities, for example. I would never want to transfer it to a buyer, but somebody needs to pay for it, because what are you going to do after those 30 years,
right.
25 years? You don't have that money. As of now, you keep some buffer reserves, financial, it's not going to work. So, but yes, Nandini, I like that to end it on, let's get real. This is a complex problem, but I think the trust fund and the insurance working this is a solution, guys. And I think we should put our weight behind it, put our minds behind it, and try and get this, and not come back after 5 years, like Alexia mentioned, and talk about the same problem. So yeah.
Perfect. Thank you so much. We're going to close with that. Huge thanks to our panelists and to the ICVCM, and for all of you out there in the market who are doing the hard work of making this market work. Stay tuned for more information, and we'll do our best to follow up with the broader group to answer some of these additional questions, because they're really important ones. So thank you for all the wonderful engagement today. Have a lovely evening or morning or day if that's what's ahead of you. And thanks to everyone.